Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So if you are looking for stocks to add to your portfolio, or just to do a little bit more research on that's still undervalued in this crazy market that we are basically experiencing right now, then you have come to the right place. I'm going to share with you guys today 5 different companies that are still undervalued despite the S&P 500 are doing about 25% whatever it was last year, and the last few days, so just for the 1 week, still up about 3%, 3.5% just for the last 5 days, and everything else is still seems very still going up to the moon. So I'm going to share with you guys these 5 companies, and then of course I will share with the Sharia compliance side of things at the end of the video. Now, one of the things that I've noticed is since Trading 212 have done basically the updates, you can see now how much we're up for that just 1 week, which is quite nice to see, and I hope it's accurate, because we're up 3.5. But remember, this is money weighted, so includes the £300 or whatever that I've actually added to the portfolio. But in money wise, for the last week, we're up about £4,185, which is quite nice. So it is, the portfolio was around, I think it was about 119,000, and right now is £123,808. So alhamdulillah, it's still going up. Like I've always said to you guys, it doesn't bother me the fluctuation of the prices of this portfolio. It can go up, it can go down, but overall what matters is in the long trajectory, in the long run, basically this is what we want to see, that basically the total returns over the last whatever years is what we're interested in, inshallah. So what I'm going to do now is share with you these 5 companies. Please, as always, do your research. We don't just rely on what I'm giving you here. And if you are enjoying the content and you're finding value in everything that we're doing, we would genuinely appreciate if you can join us in the Patreon account, where you get access to the family portfolio. I always refer this to the family portfolio. This is basically the money that comes from my rental property goes into the family portfolio and is for my family only. So I don't want to basically put this here, but you can actually get access to basically on the through the Patreon account. I share screenshots of the portfolio, how much I own, what I'm buying, what I'm selling, and all of that stuff. And then you've got loads of other things, including the Discord, where a lot of brothers are sharing very genuinely very good practices. So come and check out, inshallah, if you would like that. Now, like I said, these 5 different companies, we're looking for exact same things that we're looking for: the moat, the market cap. We're looking for the dividend side of things, if they pay any dividends. We're looking for the profitability, the profit margin. We're looking for, when it comes to return on equity, return on invested capital, the free cash flow side of things. And then we want to see the total returns over the last 10 years, expectations for the EPS, expectations for revenue, and then valuations for basically based on Morningstar valuation and for the fair value price for those companies. And the first one that we're looking for right now, looking at today, is UPS. UPS has done really well over the last 2020, 2021, because a lot of us were locked away. The company was delivering all sorts of things, and then basically the economy was doing fine in terms of the delivery side of things. And recently, over the last year and a bit, they had a huge problem with the labor, contractors and so on, which then meant a lot of their employees had to then be given a new contract, which cost them a lot more money. So that, as well as competition, is becoming a quite basically strong competition coming from, especially from Amazon. So there's a lot of other things, a lot of factors that contributed to the stock going down a lot. And right now it's only about 11% discounted right now, $145 per share. But with regards to how the company, I don't think the company is going to go out of business anytime soon. You've got 111 billion market cap. It has a wide moat. You've got over 5% dividend yield, which is absolutely crazy. The payout ratio is very high right now, I must admit. And I'm hoping that in the next couple of quarters, we can see that coming down. 87% is very, very high. The 5-year growth rate is about 12%, which is really good. The dividend streak of 14 years of increasing that dividend. $6.52 is what you will get. 69% safety. So safety wise, 60 and above is definitely safe. We don't have to worry about that. Profit margin is okay. Return on equity, return on invested capital is very good. Free cash flow of $4.3 billion, which is nice to see that, because the payout ratio is a little bit high here. So they do have some free cash flow if they need to. Total return the last 10 years, we're looking at about 5%. EPS growth for the next year is 17%. So I'm hoping in 2025 will be the year where this company bounces back. And we've seen this before. There's been a lot of companies in the portfolio that have had similar sort of situations over the last couple of years. because they are very cyclical businesses. Again, what I mean by that is some of these companies are in industries where it depends on how well the economy is doing. So if everyone is basically ordering things on Amazon, whatever, this company will do well. But if everyone is a bit more reserved and they don't want to buy those, basic discretionary items, then of course this company will not do well in terms of revenue side of things. Although they deal with basically wholesalers and so on, but they're still, the consumers are important to them. So revenue expected about 4% growth, so which is really nice overall. And if we look at it, Morningstar, you can see here they actually saying basically 15 stronger buys, 3 buys, 9 holds, 2 sells, and 1 strong sell. And it's about 15% upside from where we are. $148 per share is where they think the price should be. Right now it's about 130. If we look at the earnings expectations moving forward, 2024, that's in the past. 2025 is what we're looking at now. 2026 is even basically almost there. Double digits again every single year for the next 4 years. And when it comes to EPS side of things, and when it comes to revenue, is almost the same as what it has done over the last whatever years. Especially in 2028, they're expecting about 8%. Although it's only 2 basically analysts looking at that. So I'm not really concerned about the company. And like I've always said to you guys, this is probably one of the companies that I still feel is cheap, and I will continue adding to it, inshallah. I think I will share with you guys how many shares of this company I own right now in the portfolio. GSK is the next one. This one is basically UK based, but I'm using information on basically American side of things. 67 billion market cap, wide moat, $33 per share right now. Dividend of 4.7, so almost 5%. The payout ratio is less than 40%, and they don't basically, they cut I think the dividends because they had a spin off recently. In terms of dollars, you'll get $1.56. Safety 70%, profit margin it's about 8%, return on equity 18%, return on invested capital 23%, which is really good. $6.3 billion in terms of free cash flow right now. Total return in the last 10 years, we're looking at about 2%. EPS growth expected to be about 7%, then 4%. 42% discounted right now. $58 per share is where they think the price should be. And just looking at the earnings expectations for this one, you can see that about 7% and then 5% after that. So that was 2024. I think they've got one more quarter to report, and then about 4-5% in terms of revenue growth expected to moving forward. Now, in terms of ratings from Wall Street, as you can see, it's a buy for Seeking Alpha analyst. Wall Street is saying it's a buy as well. And then we have about 33% upside from where we are. $44 per share is where they think the price should be. That's the second company. The third one is Rio Tinto, another company that I own in my portfolio that I'm down a little bit right now, over 100 billion market cap. Very, very cyclical business. It depends on China, it depends on iron ore prices and so on. So commodity basically almost like company, because anytime the iron ore prices go down, this company goes down and so on. Now, dividend yield of over 7%, which is absolutely mad. 60% when it comes to payout ratio, which is not bad at all. The 5-year growth rate basically 8%. The dividend streak basically just 1 year, because they cut the last year. I think it was almost 9% or 10% or whatever it was, so they cut that a little bit. Annually, you get basically $4.34. 40% dividend safety from Simply Safe Dividend, which is not great at all. So that basically it's not safe at all. And again, I know that for sure because they did it, basically they cut it while I still own the company and I still hold it in my portfolio. The reason why I have this company in my portfolio is that dividend income side of things. And to be honest, when you look at the total return for this company over the last whatever years, basically is actually quite decent. Okay, so we're looking at about 9% basically per annum over the last whatever years, which is good. Now, profitability side of things is good in terms of return on equity, return on invested capital. All of that is good. $8 billion of free cash flow. Total return, like I said already 9%. They're expecting the earnings to decline about 1, and again that can easily change depending on iron ore prices and so on. 15% discounted right now. So according to Wall Street, is actually strong buy. We've got 5 buys, 1 buy, and 5 strong buys and 1 buy. And then we've got about 30%, 31% upside from where we are right now. $80 per share is where they think the price should be. Right now about 60 something. And if you look at the earnings expectations moving forward for this company, you can see this is the one that so 2024, I think they got 1 more quarter to report, and then basically as you can see there's a bit of a decline, then they bounce back, and then a bit of a decline. And that's quite normal for this type of businesses. Very, very cyclical, like I said. So you need to know what you own and why you own it in the first place. So don't buy these companies thinking that I'm going to make a lot of money, but you need to know what you're getting into. The next one is Merck, probably one of the best in this on this list. 449 billion market cap, wide moat. Right now it's over 3 and almost a 3.3% in terms of dividend yield, which is amazing. Payout ratio is very low. The latest, the 5-year growth rate, we're looking at about 9%. Different basically streak of 12 years, $3.24 is what you get. 90% safety, one of the highest on this list right now. Profit margin, return on equity, return on invested capital, probably one of the best companies out there. Almost to $15 billion of free cash flow. Total return about last 10 years, we're looking at about 8%. They're expecting the earnings to grow about 23% next year. EP in terms of revenue, 5%, 18% discount right now. 120 is the price right now. That is about $97 per share. And just to kind of show you where we are now in terms of 2024, they still haven't reported the final one. And then 2025, we're looking at basically 21%, 11%, 10%, and so on. And then revenue, we're looking about that 5%, 6% every single year. In terms of Wall Street, basically we've got Wall Street is saying it's a buy, Seeking Alpha is actually also saying a buy. And we've got 14 strong buys, 5 buys, 7 holds, and then 28% upside from where we are. $125 per share is where they think the price should be. And finally, AstraZeneca is another one that I own in my portfolio. As you can see, we've got basically 3 UK companies here that I own actually in my which I own in my portfolio. AstraZeneca, another pharmaceutical company, 206 billion market cap. Now there has been a bit of an issue with this company, and I think that's still an ongoing situation where the CEO and other people have been basically accused of doing something dodgy in China. So that's still ongoing. The stock went down quite a lot because of that. So right now it's about 15% discounted, $78 per share is where they think the price should be. Dividend is decent in terms of the profitability side of things, absolutely fine. 7% free cash flow or basic, which is really good. 8% total return the last 10 years, and they're expecting the earnings to grow about 15%, revenue to grow about 7%, which in my opinion is absolutely amazing. And finally, I'm going to show you guys in terms of the ratings from Morningstar. So 6 strong buys, 4 buys, and 1 hold, and about 29% upside from where we are. $86 per share is where they think price should be. Earnings expectations moving forward, we got 14%, 17%, which is absolutely fine. And then we got 16%, which is basically still in 2024, and 2025 we look expecting about 7%, 6%, and so on. So all of these companies are decent companies that right now basically loved and under-owned. So is possible, for me, I will definitely say it is still undervalued, and I will be buying every single one of them apart from GSK. This one here is on my watch list because I'm looking at right now adding to another company potentially to my portfolio. That's pharmaceutical companies, because I do have these 2. I don't own any others. Basically I've got another company that I've been looking at, I've talked about recently. So I don't know, we'll see how it goes, but this probably will be one of the companies that I potentially might add to it because it seems very cheap. It's a great company. Their product is everywhere, and the spin-off, I wish they had that spin-off because it basically looked like J&J. Anyway, so that is what I want to share with you guys today. Sharia compliance side of things, you can pause the video and have a look at that. If you haven't joined us at the Patreon account, please do so. Have a wonderful day. Assalamu Alaikum.